Hello there. The economic stimulus plans of the new government led by Liz Truss in Great Britain are sending shockwaves through the economy. As you all know, the pound has plummeted, interest rates have skyrocketed. And now the Bank of England, the BOE, reacts. The Bank of England has taken emergency measures to prevent the UK economy from deepening its crisis further. With a view to the pound's plunge after the new government unveiled its debt plans, the central bank said on Wednesday there was a significant risk to Britain's financial stability if the situation persisted or worsened. The bank therefore intends to purchase long term government bonds with immediate effect without an upper limit. With that, they want to stabilize the market. Similar measures have been taken in the past during the financial crisis or the corona pandemic, but never to limit the effects of their own government's budget plans, said the German British economist Andrew Lee, who works at the Baden Württemberg Cooperative State University. Württemberg is the university is in Karlsruhe, and they were talking to the German press agency. And they said this is completely unprecedented. The new Chancellor of the Exchequer, or Finance Minister Kwasi Kwarteng, announced significant tax breaks on Friday, which primarily benefit the rich and whose financing is unclear, probably debt. He and Prime Minister Liz Truss want to boost economic growth with what has already been derided as quasi-Katze. Truss and Kwarteng put their foot down, and the Bank of England is now effectively keeping the car's engine from exploding, said expert Lee, which is a weird situation. The head of Britain's largest opposition party, Labour, also blames the government themselves for the fiasco. Keir Starmer called on the finance minister to take the unusually harsh warning from the International Monetary Fund, the IMF, seriously and to turn the tide. The IMF had announced on Tuesday evening that large and untargeted financial packages are currently not recommended in view of the high inflation in Great Britain and many other countries. It is important that tax policy does not work counter to monetary policy. The nature of Britain's action is also very likely to increase inequality, they say. However, not everyone is willing to accept that the government that succeeded Boris Johnson's cabinet worsened rather than improved their country's economic situation shortly after taking office. Blaming the fall in the pound on these tiny tax cuts is like a fly perching on a horse lying to sleep, telling itself it wrestled the mighty beast to the ground. That's what the conservative columnist Daniel Hannan wrote. He's also a member of the House of Lords, and he wrote this in a post for the Conservative Home Portal. Rather, the financial markets are unsettled that Labour leader Starmer could possibly lead the government in a few years, said Hannan, which is complete bullshit, sorry. The pound sterling soaring is a loss of confidence on the part of the financial markets and the fiscal policy of the British government. With that counters Alexander Altman, partner at the London-based auditing firm Blick Rotenberg. Unlike in the 1980s under Prime Minister Margaret Thatcher, the current tax cuts are not counter-financed. In times of high interest rates, this could result in a downward spiral. Economist Lee points out that for many home and apartment owners, paying off their loans is likely to become significantly more expensive. In the UK, buying property is far more common than long-term renting. Even in the supermarket, almost everyone should feel the effects. In September, food prices rose at an unprecedented rate of 10.6% year on year. You might have seen my video already. And according to Lee, high inflation always hits the poorest hardest. As long as the pound is weak, all goods from abroad will become correspondingly more expensive, and a lot of food comes from abroad. How things will continue in Great Britain depends, on the one hand, on further interest rate decisions by the Bank of England, and on the other hand, on what the Chancellor of the Exchequer Kwarteng announces in the next budget at the end of November. The date offers an early opportunity to make the support package more targeted and to adjust tax plans. That's what the IMF warned, especially those for the top earners. The UK is definitely not alone in facing the challenge of finding appropriate responses to the energy crisis and rising prices. However, economist Lee finds the German federal government's approach of providing direct aid to companies and poorer households that are particularly under pressure more convincing, even if he advocates more targeted relief than, for example, the €300 flat rate for energy costs. However, there is really no country that has such an absurd plan as Great Britain. That's really not a benchmark, he says. And he is so damned right about this. And I'll see you in my next video. I'll be back.